All right. Today is Wednesday, the 16th of April. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Interesting day. We thought it's going to be dull, and it turns out it's going to be not so dull once Mr. Powell began speaking. So let's just dive right into it here, folks, and we begin with the headlines of the day. You see, we spice it up here in the Maverick Wall Street because sometimes it is in focus, sometimes it is commentary, sometimes it is headlines of the day. And the first headline I got for you is from Jay Powell. He was speaking today at the Economic Club of Chicago, another one of those satanic clubs, with the weird sexual rituals and that kind of stuff. But anyways, why was the speech by Mr. Powell or the interview upsetting for the stock market? The first reason is, of course, him saying that I cannot really cut rates, folks. He didn't say that bluntly, but he hinted to that. He said that we're going to stay ground here, and we know why. Because he's worried about the tariffs. He's worried about the inflationary reaction by the tariffs. So he cannot afford to do an emergency cut or even a regular cut and then assume the responsibility if inflation heads higher. He wants to make it clear that inflation, if it heads higher, that is the White House's fault. It ain't the Federal Reserve's fault. So there is a little bit of war underneath it all going on between the Fed and the White House. And I think that Powell right now doesn't want to do it, even though he might see some problems going on in the economy and in credit markets, for example. But he's not going to do anything about it because he knows that inflation is going to go higher either way as a reaction of these tariffs. And he doesn't want to assume the responsibility. He wants to point out at the White House and say, look, I was doing a good job. Inflation was going down. They screwed it up. I did not cut rates and cause inflation to rebound. That's all in the White House. So that's reason number one, that Powell is not going to cut rates. And by the way, he kind of hinted, and at least some Fed members were talking about that, about a rate hike. That's also not merited right now because we have a lot of recession problems in the economy. So you cannot really hike rates right now, but I think the market took that as a possibility down the road if we see inflation heading higher. And that would be, of course, disastrous for the stock market. The worst case scenario is stagflation. If you see recession infecting the economy, but at the same time, we have a sticky or rising inflation problem. That's a death sentence for any economy. And the Federal Reserve has to blow the whole thing up. And that could, by the way, lead to not just a recession, but a depression. So when Ray Dalio talks about, I'm worried about something more than a recession, well, that's a possibility. But the other reason why the market was upset because of Jerome Powell is he pretty much said, I don't really care about the market. The reporter said, is there a Fed put for the stock market? ? The response by Powell is, I'm going to say no, with explanation. In other words, if the shit hits the fan and the stock market crashes in a big way and it becomes sort of a systemic risk and a financial risk in the economy, yeah, there is a put. But the put is not even close to the levels that we're trading at right now. This is not it. I'm not going to interfere to fix this right now. I'm not going to waste ammo. So this was the second reason why the market was upset with the interview with Jerome Powell. But again, can he really do anything when you have inflation expectations surging higher like this, the highest levels since 1981? It's impossible. He's going to assume a lot of risk that unnecessary, really, because we also have negotiations in the tariffs. We have flip-flopping in the tariffs. So who knows? There's uncertainty, and it doesn't merit the Federal Reserve to take a decision right now. Furthermore, we got retail sales in the morning, and we, as anticipated, of course, retail sales moved significantly higher, increasing by 1.4% in March. And the reason is we're front-loading before the tariffs hit. Now, the Fed looks at this data as maybe we're going to see, at least in the short run, we might see inflation showing up. As we see consumer demand surging, we might see inflation. Of course, that rate of inflation is going to be lower than when the tariffs actually hit, because this increase in inflation is a result of an increase in demand for front-loading. So the Fed has no ground and no reason and no excuse, to be honest with you, to begin cutting rates right now. And that's, of course, upsetting to the market because the market is looking for an exit. The market is looking for a rescue. It's not coming from the White House, and now it ain't coming from the Federal Reserve either. Now, the second headline I want to cover is this one right here. So we got LVMH, Louis Vuitton, of course. It was overtaken by Hermes in market capitalization as sales disappoint.
Oh, this is beautiful, Tony, with my black coat.
It's a Hermes. Supposed to be the best.
Why do we care about this headline? Because LVMH and Hermes, by the way, if they begin to go down, that's a more accurate indicator of a recession than the Ho indicator, because both the Ho and the John, they're shopping at these stores. And if sales are going down, what is that saying? I mean, you look at the chart of LVMH. It looks to me that it traded in a range for a little bit, and it was actually an outperforming stock when everything was going down in 22, if you guys recall, because of China's strength. Well, China weakened, and now the rest of the world is weakening, specifically the United States. So we see the chart breaking down, as if it says it topped, and now it's heading down. Furthermore, look at the monthly chart. We have a nice stopping head and shoulder pattern. I think we head down here in LVMH. And we have a trend line to test here. If that fails, then we have further downside to go. And even RMS, Hermes, same thing. It went down, touching the trend line, looking a little better than LVMH, but it's going to have its time too. I mean, honestly, in an economy like this, who wants to overpay for this garbage? It's all crap that could be made in China. I mean, why would I pay $6,000 for a fucking scarf? It never made sense to me. And oh, by the way, if this trade war is all about bringing back the manufacturing jobs in this economy, how's that going for Louis Vuitton's factories in Texas? Well, they're plagued with errors, waste, as it ranks among the worst performing globally. Whoops. Maybe it's not a good idea to bring manufacturing here. I mean, think about it this way. If I'm going to buy a Louis Vuitton bag, not buying it made in here, it better be made in France or Italy. It's the same thing if I'm buying a German car. It's better be made in Germany. If I'm buying a Japanese car, it better be made in Japan. I mean, you look at the Audis that they make here, they're absolute trash. The quality is shit. The best example, of course, is once the Japanese stopped producing Honda Accords. I mean, Honda Accord is a legend. It used to live for 1 million miles. You could drive that thing till infinity. It wouldn't break. All you got to do is just change the oil, to be honest with you, even though you can skip that too. I would say that I rescued a Honda Accord from my wife. And I said, hey, you didn't change the oil for how many thousands of miles now? She's like, well, it never really told me. As if the car is going to speak and tell you need to change the oil. Anyways, I rescued the car and I changed the oil. And all I had to do is just change some spark plugs and minor stuff. And it was smooth as butter. One of the best cars I ever owned. But once they shifted the production of the Accord here in the US, the quality went to shit. And right now you slam the door a little too hard, the whole car falls apart. So when we talk about what is the point of the trade war and the tariffs, is it really to bring back the factories to the US? Because that's going to lower the quality, number one. Number two, who's going to work at these factories? This is the question that I've been asking. Who the hell is going to work in these factories? Seniors? Retirees? Kids? Well, we know who's going to work in these factories. It's going to be immigrants that we're getting from Guatemala, El Salvador, and Mexico coming here illegally. Although in this case, we have to give them something to be legal to work at these factories. So what is the point here? What is the point? And of course, as I said, LVMH going down, that's a bad sign for a global recession because both the Hoes and the Johns are now getting broke. But rest assured, if you think that the affluent consumer is tapping out, we have one indicator that is still okay for now. And that's the Broadway indicator. So we have good night and good luck playing out in Broadway in New York. If you want to pick tickets for Friday's performance, not this Friday, but next Friday, these are not the best seats, by the way. You're still paying about $4.50 each for a ticket. Who the hell can afford that? But the show's selling out like hotcakes. So that shows that we have at least some healthy demand by the affluent consumer. Now, the third story I want to hit here is read China. So we got the headline yesterday that China is pretty much banning, issuing at least a notice to all airline operators in China that they better stop buying Boeing. They blocked all of the buying and all of the orders of Boeing planes as a retaliation against U.S. companies. This is a big deal. And if China cancels orders, what do you think will happen to the factory jobs that we have here for Boeing? So all of this stunt of saying, hey, we're going to bring the manufacturing jobs to the U.S., we're actually going to lose jobs if this trade war continues like this. And of course, any factories coming here will be filled by illegal immigrants. So what is the point, folks? In the damage, you can see it here. This was really interesting to look at. What you're looking at is the pre-pandemic top in both Boeing and Airbus. So you have Boeing in blue, Airbus in red. You can see that Boeing is down over 50% from that point. Airbus is up 4.5%. That's a loss. Of course, Boeing has its own problems, but I see this as a worrisome sign about the global demand for U.S. goods and also the perception of quality of U.S.-made goods. Boeing used to be the pride of this country, and now it's being overtaken by Airbus. What a shame. Now, here's the other thing you have to keep in mind. Because right now, China can block or ban Boeing planes and buy Airbuses instead. But they also have their own manufacturers, the Chinese local planes, the C919, for example. And I guarantee you, as the writer here in Bloomberg suggests, that we're going to see the U.S. government banning the supplies, the jet engines, by Honeywell and GE, so the Chinese cannot manufacture their own planes. That's coming, and that's going to be bad for GE. That's going to be bad for Honeywell. So that's Chinese demand that no longer available. If that is the case, are we going to lose factory jobs, not just in Boeing, but also GE and Honeywell? How's that working out? And I know what you're going to say, but this is Maverick. This is a national security issue. We cannot allow the Chinese to surpass us, and we have to block NVIDIA AI chips, or we have to block the jet engines, GE and Honeywell. Otherwise, in time, they're going to figure out how to make their own engines, as they did with everything else, really. Point taken. And it is valid, but all I'm pointing out here, there is a price to pay by the U.S. consumer, U.S. economy, and the U.S. stock market to deal with China. If you want to neutralize the Chinese threat, there is a price to pay. It's not a cheap price. It's a steep price. It will cause a lot of unemployment in the country. It's going to cause the stock market to crash. It's going to cause the economy to go to stagnation for years. And the question right now, it sounds pretty good to thumb on your chest and say that, yeah, we should stick it to China and all of that. We should stand up to China. That's all good talk. But once you lose your job and you begin to feel the economic pain, would your perception change? Or would you say, you know what, it's worth it? It's worth it because 50 years from now, when I'm not alive, I still want the U.S. to be superior to China. Would you really give a flying you know what at that point? That's something to consider here. And since we're talking about airlines, all of this is causing a lot of uncertainty. I think one of the most fascinating headlines that we got, at least so far this week, is from United Airlines. So they reported earnings yesterday. And the report was good, but they gave two 2025 profit outlooks. One for the regular outlook that they had before, and another one for a recession scenario. And that just illustrates that companies have absolutely no clue how to deal with this, because we don't even know what is tariffed. We don't even know what is the rate really going to be. We don't know anything. But all we know, if this continues, the psychology, the recession psychology will be embedded in the economy. It's going to be a self-fulfilling prophecy, as it usually does. If that is the case, United is saying, watch out, our profit guideline is going to be much, much worse. This is a great illustration of the confusion and the uncertainty that's going on in the economy right now. And if there's one thing that the market doesn't love is uncertainty. Now, we got to watch out for crude oil too, because if jet fuel cost goes higher, along with recession in the economy, that's going to be really, really devastating for the airlines. And today we've seen oil going higher, while the equities market going down. We'll talk about that in a minute when we cover the futures, aka the commodities. Now, the fourth headline that I want to cover, and it kind of ties in with the third headline, it's again about China. So we know that we have about 145% tariff on all of the goods coming out of China. But do we have a deal in the pipeline? Is this, all of this chaos will lead to something positive? Is there a light at the end of the tunnel? And the answer is yes. But there are a lot of complications. The biggest one, of course, once you raise the tariff rate to 145, and they have 125, they got to reduce it by a lot, because they can go to 50% and call that a win. But that's much, much higher than it was before. So we need both the US and China to reduce the tariffs all the way below 20%. And I see that as a long shot, to be honest with you. The other problem is the Chinese say that we are ready to talk with the US, but you got to show respect. Now, what does that mean, respect? They're talking about the interview that Vice President Vance gave, I believe over the weekend, when he called Chinese peasants. Now, I think there was a language barrier. He didn't mean all Chinese are peasant, obviously. He said that the factory workers that we're employing are peasants. Maybe could have used a better word than that, who knows? But the way China heard it, that he called all Chinese people as peasants. And that's insulting, that's not respectful, and they don't want to talk, unless there is an apology from the VP. Will the VP apologize? Again, there was a language barrier here, so I don't know. Maybe we're just going to play this stubborn game and cause an economic nuclear winter, as Snake Bill Ackman says. More on that in a minute, by the way. But when we talk about China, we talked about banning Boeing, and we talked about what's going on with the trade negotiations. They want to talk, but they want the VP to apologize. And they sent a really strong message to the Trump White House by dumping T-bills, because that caused the problem that forced Trump to capitulate. But we talked about that in details in the weekend video. I thought that the interview that we got today with Secretary Bessent was really important, because either he's naive or he's playing stupid, because he says that China has not weaponized U.S. Treasuries despite bond market volatility. Or really? And who was dumping, Scott? Because the auction was pretty good. Everybody was buying. But there was one whale who was dumping. Who's the whale? We only got two major whales. Actually three, but we know one of them is not going to do it, which is Japan. Whale number one is the Treasury Department. Are they really dumping their own product? I don't think so. The other one is China. So China was dumping. Now, we could see a solution to that, either by China stopping the dumping or what Scott Bessent talked about in this interview. Here it is. He's going to pull a Janet Yellen. We have a big toolkit. We do buybacks. I think if treasuries hit a certain level, or if the Federal Reserve believed that a foreign, I won't call them an adversary, but a foreign rival, were weaponizing the U.S. government bond market or attempting to destabilize it. For political gain, I'm sure that we would do something in conjunction with each other, but we just haven't seen that. In other words, what Scott Bessent is saying, if we get conclusive evidence that China has been dumping, or they resume dumping again, we're going to launch a massive bazooka, along with the Fed, in buying bonds. Well, that might be bullish for the TLT, but here's the problem. If you do that, you're going to increase the national debt problem. And in time, that's going to cause more and more foreigners to dump U.S. bonds. So it might give you a relief in the short run, but it's going to portray lack of confidence in the U.S. economy and the U.S. stance in the world. And we will see more and more foreigners dumping. And can the Treasury or the Federal Reserve buy more than the dumping at that point? Because the more they buy, the more they add to the debt, and the more destruction of confidence we see by global buyers. And this is really naive. Bessent says it's not in China's best economic interest to sell. I could burn down my house if I had an argument with my spouse. Well, China's not our spouse, so what the hell is he talking about? But it's not going to do me very much. If they started selling treasuries, they would, they'd have an effect on the price. Or you think, they're already been dumping. If I can see the data, how the hell can you not? Scott Bessent adds, but more importantly, they accumulate dollars. And what are they going to do with the dollars? ? Oh my God. Is he really that naive, folks? Is he really? What are they going to do with the dollar? Haven't you seen what happened to gold, Scott Bessent? Come on. They're dumping U.S. bonds, collecting the dollars, and then using the dollars to buy gold. But Scott says then they have to buy RMBs. No, they can buy gold, which they've been doing so far. And it would strengthen their currency. And they've been doing just the opposite. They've had a weak RMB policy, so it really served no purpose for them to weaponize treasuries. The most naive take I have ever seen. And this is not by a child. This is by the secretary himself. He's supposed to know all of this stuff, but he doesn't. Somebody please tell Scott Bessent, grab a chart of gold and let me know who's been buying. Who bought over $100 million worth of GLD calls today alone? We'll cover that in the unusual activities in a minute. But the last headline I want to cover, it ties in with Snake Bill Ackman. Today you might have heard the news that Hertz, a company that we talked about yesterday, that if the European consumer or traveler stops visiting the U.S., it's going to be banned for rental cars, including Hertz. Well, today Hertz moved higher significantly because of Snake Bill Ackman. He accumulated a stake in the company. Problem number one, why would he buy Hertz at this point? What is the thesis? There is none. With a slowdown in the global economy, a slowdown in travel, the demand is going to go down. The only reason for Bill Ackman to buy is manipulation. Take a look.
Well, it's been a very busy news hour, as you know, and I have some new news for you, something we'll call new on Closing Bell exclusively today. It is regarding Bill Ackman this afternoon, his Pershing Square revealing today in a 13F filing a 4.1% position in Hertz as of December 31st. That news sending shares sharply higher in the session, as you see. I'm told from a person familiar that the stake is actually much, much higher than that. About 19.8% through shares and swaps. Pershing, in fact, now the second largest shareholder in Hertz. I'm also told that Pershing received a confidential treatment provision from the SEC, which allowed them to delay the filing beyond the normally required reporting period, which gave them the ability to accumulate substantially more shares since the end of December. Worth noting, too, that not all of those types of SEC requests get approved. They did.
So here we have a billionaire, top Trump donor, getting a preferential treatment by the SEC by allowing him to accumulate in the shadows without having to file or to disclose. Once he's accumulated all of these shares, rumor has it that he's the second largest shareholder of Hertz right now. And the name has about 38% short float, so a huge short position in the name. If you don't disclose that you've been buying, because the SEC did you a favor, an exception, and you accumulate such a huge position. And on the day of the announcement, in the closing hour, you send information to CNBC saying that actually the position is bigger than previously announced. And the stock now rallies from what was 13 to 20% now by more than 50%. Why? Because he caught the shorts by surprise. This was an organized operation. It's not investing. It's not that he believes in the company. He spotted a snake-like opportunity and he struck. And he struck because the White House gave him an exception. Is that really a free market? I don't care you're MAGA, you're Gaga, doesn't matter to me. Is this acceptable, folks? Under no circumstances it is. Anyhow, let's move on here and add more color to this conversation by revisiting the market activities today. We begin with the closing of the indices, and here we go. The diamonds in the red, down by 699.57 points, or a loss of 1.73%. So value, defensives, not doing so hot so. The Nasdaq, the loser of the day, down by 516.01 points, or a loss of 3.07%. Huge decline for the Nasdaq, led by the chips and the news that we got from NVIDIA. Then came AMD with a rains of pours, of course. Then after that came ASML with a bad report. So a huge tragedy in chips led the Nasdaq down. The Spider, also in the red, down by 120.93 points, or a loss of 2.25%. And believe it or not, the Russell 2000, the leading indicator, was actually the outperformer today. So what is the message here? The message is the damage is still limited to chips and certain names. The Russell 2000 closed negative, down by 1.79 points, or a loss of 0.96%. Now, if the Russell begins to lead to the downside, now we have a confirmation of the resumption of recession fears. Looking at these sectors, all negative, led by tech, cyclicals, services, comm services. So anything that is growth, anything that is related to chips or semiconductors got absolutely hammered today. The only sector that closed positive is energy. So this is not looking pretty good, folks. This is a stagflation theme right in front of you. That energy goes higher, but the rest of the market goes down. Looking at the market breadth, the NYSE 32% advancing, 67% declining, similar percentages in the NASDAQ. 30% advancing, 68% declining. So if the market maker wants to go further down and accelerate the sell-off, they have plenty of room. 30% advancing is not really that oversold. If you go down to the teens, then we are. While we're at it, here's the heat map for you. Any theme to extract here? No. The theme is we have wreckage in technology across the board. Investors are exiting with the news coming out of NVIDIA. Now folks are beginning to realize that the AI bubble is over, which means that NVIDIA is a short, not just put options. Short. Meta is a short. Apple is a short. Microsoft is a short. This is what the big guys are doing. This is what the big hedge funds are doing right now. They're actually shorting, because this is the end of the bubble as we know it. And this is where the opportunity is, folks. But we see everything pretty much across the board heading down. The biggest tragedy, in my opinion, is healthcare. When you see names like Merck, like AbbVie, like Amgen, like Bristol Myers getting hammered. This was one of the few bright spots on the map, now absolutely destroyed by the threat of pharma tariffs. So we can't do healthcare anymore. Can we do consumer staples? Well, that's going to be subject to tariffs too. But right now we see Kroger. That's the safest name, biggest asset that I own. It's the only one that is consistently going higher. And then we have the beer, Budweiser, Tapestry doing pretty good. But you see, even the packaged food companies went down. PepsiCo went down. Procter & Gamble went down. So we're even losing that corner of the market. What's still alive? Even utilities are not alive anymore. You got NextEra Energy down by about 3%. What's alive? What's alive is defense contractors, Lockheed, Northrop. This is what we're really good at. We produce oil and we produce weapons. That's what this country manufactures. And that's what we're good at. We're the best. In producing weapons, we're the best. And then you got gold miners for now. We talked about China hoarding gold, and that's good for the gold miners right now. Energy all of a sudden making a comeback. Why is energy heading higher? Let's talk about commodities, folks. And of course, we can talk about what happened today in gold or copper or wheat or OJ. We talked about all of these charts in a previous video, so you know exactly how to deal with them. But the main headline of the day when it comes to the commodities market was in crude oil. Because despite the negative commentary by Powell, which the market received as recessionary, crude oil held its gain. It didn't go down. It traded higher. What is the reason behind that? Well, we got the news that U.S. gasoline distillates inventories continue to fall, so supply is going down. That's, of course, a positive. But I think the news that really increased the price of oil, at least in Brent, now that you have a reduction in supply in the WTI, you also have a reduction of supply globally because we're now cracking down on Iranian oil supply. Once again, folks, you can shoot the messenger and say, but this is necessary, Mav. We have to tackle Iran. We have to tackle China. Maybe it is. But I'm just saying that there is an economic price to pay. And it's a hefty one. Just keep that in mind. You're gonna feel the pain, I promise you. And then we'll see how you think about being tough on China and Iran. Here comes Bessent again. He says the Trump administration has made one thing clear. We will apply maximum pressure on Iran and disrupt the regime's oil supply chain and exports, which support terrorist proxies and partners. Any refinery, company, or broker that chooses to purchase Iranian oil or facilitate Iran's oil trade places itself at serious risk. We are prepared to take all actions available to get Iran's energy exports down to zero where they belong and keep Americans safe. Okay, you can only take them down to zero if you blow up the facilities. Is that what you're talking about here, Mr. Bessent? I want all of you to do yourselves a favor and grab a map of the world and look at how far Iran is from the U.S. Why are we getting involved in all of this? That's an interesting question, isn't it? Moving on to the big casino options, what do we see here? The volume is still shy, but it did move higher in today's session. So we have participation. But the participation right now in buying puts, we see puts at the 40s, at the 50s. Huge confirmation of a bear market, by the way. So we've seen an increase in volume in buying puts. That's a net negative for the market. Is it too late, though, to add to your existing trades or buy new puts? No, it's not, because the IV ranks cooled off from 100 to 60s to 40s to 50s. So the puts are a lot cheaper than they were a few days ago, which means that if you held on your puts, you lost a little bit of value. So if you think the market is going to head down, we get more confirmations in tomorrow's session. You want to average down. You want to take advantage of lower volatility to increase your stake. So if we see the market heading down and these stocks heading down, you get to enjoy the increase in implied volatility. Let's do the unusual trades here, folks, beginning with the bullish ones. Unbelievable trade here. GLD. We talked about somebody hoarding. Look at this one here. Buying the 310 and the 315 calls. The expiration date is June 20, 2025. Spending about a little over $127 million. Who do you think has these kind of deep pockets? Anyhow, here's another one for you for Crocs. CROX. We have earnings coming out really soon. Maybe somebody knows something here. The stock is trading at about 88. But we have somebody who bought the 100 and the 110 calls for the expiration date of May 16, 2025, spending about a little over $1.5 million. Maybe they know something here. The next one is CRM. The stock is trading at about 250 right now, so this is not too far out of the money. Probably somebody who wants to take a shot at a rebound in technology. And they bought CRM 260 calls. The expiration date is July 18, 2025, spending a little over $1 million. Another bullish one for you for UAL. Again, the report was good, and I think UAL should be trading higher, at least for a few days from this point on. But it was sold off with the rest of the market today. Now, we have the 70 calls. If you followed me in Discord, we have the 70 calls for the expiration date of next week. Here we have somebody who bought the 70 calls for June, though, June 20, spending about a little over $1 million. Look, if we have UAL rebounding tomorrow, and the 70 that we sold for this week expires worthless, what you want to do is you want to open the 75. Of course, condition UAL trading higher. It needs to be trading higher tomorrow, closer to 70. If you see that, let the 70 that we sold for this week expires worthless, and then open the 75 as a debit spread for next week. That way you can have a high chance of profitability. Moving on to the bearish ones. What about NKE Nike? I think this company is going to cease to exist at some point, and it's going to be sort of a branding case. How this brand lost touch with the Gen Zers and lost its appeal in the Chinese market. In this case, somebody bought the 52.5 puts. They sold the 45 puts in what known as a bear put spread. The expiration date is May 16th, spending about a little over $1.25 million. Got an interesting one here from Meta. Somebody bought the 445 puts. The expiration date is June 20. We're trading right now at about 500, so they're betting for at least a drop of about 60, 70 bucks. And they spent about a little over $5.5 million. If the AI mania is over, you gotta short Meta. You gotta short NVIDIA. I'm already short NVIDIA. I'm gonna short Meta either tomorrow or by next week. Then we got the K-Web, so no optimism when it comes to China here, at least according to this trader. They bought the 27 puts. The expiration date is September 19th. spending about $2 million. Could be a hedge if they own the shares of K-Web, but it shows lack of confidence either way. And here we got Uber. We talked about Uber could be a casualty as the economy slows down and we have a really horrific tourism season. Somebody bought the 70 puts, so maybe snake Bill Ackman at least. There's a little bit of justice here. Somebody bought the 70 puts. The expiration date is May 16th, spending about $1 million. And then we have a really unusual one here, probably an insider for FSLR. And this stands for First Solar. Somebody bought the 190 calls. The expiration date is August 15th. Now the stock is trading at about 125, so that's a huge bet. We have earnings coming out soon. They spent about a little over $1.5 million. When I look at the chart of FSLR, weekly chart, it's been selling off consistently, coiling up for a big short covering move. If you give it any good news, I think the trader right here knows information that the report's going to be good. It's going to cause a short squeeze, and that's what they're betting on right now. Doesn't mean that they're going to be right, by the way, but I'm just speculating here that this is an insider trade because they went way out of the money. And I want to begin with our indicators that I gave you a couple of videos ago. This is your guideline, by the way. When you see more bearish indicators hitting their targets, you got to take action. There are no invitation cards. The more of them hit, the higher the level of certainty that we have. So I want to begin with the E-mini futures, and let's see if we are above or below 5,300, aka the Mama Bear level. And right now we're a touch above, but it doesn't look pretty good here. We kind of violated a little bit in the hourly chart before, and now it appears that we're doing it again. If that is the case, you're probably going to lose it. So tomorrow's session is going to be really detrimental because it is the last session before the Easter holiday. Will the traders feel that adding risk on before the long holiday is the right move because we might get trade announcements? Or will the traders decide to say that no, risk on is not worth it and we have to risk off? We have to sell before the Easter holiday because we might get worsening of the trade news comes the long weekend. This kind of psychology is going to be really important because it's going to dictate whether we lose 5,300 or trade above. If we lose it again tomorrow, that's going to seal the deal, folks. And while we're at it, how about the SPY? So your warning was losing the Fibonacci retracement 532.42. This is not a confirmation of bearishness, but it is a confirmation that we're heading to that point. So that's a major warning, but losing 5,300 in the E-mini futures is the ultimate confirmation. And what about the HYG? It's not quite at 76 or below, and should we wait till it hit 76 or lose it? That's going to be a little too late. You're probably going to see the market down 2-3% at that point. So your leading indicator that we're going to lose 76 in the HYG is the 2 hours MACD indicators I'm highlighting right here. If that begins to slip, if we see rolling over in the momentum, then we're done with the bullishness that began right around here with the pop, the flip-flop, and now it's over. And HYG is going to head down, and now we're going to talk about credit risk, and that's not going to be good for the market. And what about crude oil? We're looking at the 2 hours chart. Do we have bearish confirmation? No, crude was the outperformer as we talked earlier in the program for the reasons that we specified. So crude oil right now is not giving any confirmation one way or the other, but the fact that crude oil managed to close positive, it shows that even if there is recession fear, the news that we got today, Iran and the supply, it might move oil higher as we resume the recession fear, as we see bond yields going down, as we see equities going down. That's going to be the worst case scenario, folks. If crude moves higher while the equities market go down, because that's going to be a solid confirmation for stagflation. If you thought that Jerome Powell's hand is tied at this point, he can't do anything, and that was upsetting to the market. Think of what Jerome Powell's hands will look like if we have oil surging higher while we see equities market and the bond market heading down, or it could be also that the safety of bonds. We could go back to the safety of bonds, change our mind. Either way, if you see wreckage in the stock market and more recession indicators, but crude is heading higher, I think the Fed will be even more handicapped. Now, what about the VIX? We're not above 37 yet, but we have worrisome signs. So we're looking at the 2 hours chart of the VIX, and we see that we have bullish momentum building up. But we also see the possibility of an inverse head and shoulder pattern suggesting that in time, Maybe by tomorrow's session, we might take 37 and trade above. Now, if you watched my, if you read my morning brief that I issued today, you can see the contrast in the 2 hours MACD and the daily. So the daily MACD suggests that we have a shift from bullish to bearish, but I would suggest that the 2 hours is your leading indicator. So if we begin to trade higher, cross above 37, what you're going to do is you're going to see here in the daily chart of the VIX, you will see that this momentum in the MACD shifting back up, not ready to end it yet and head down. There's another leg higher in the VIX. That could be, of course, A, B, C pattern to the upside. What about the 10-year yield? What do we do with this one? Because this one is a little tricky here. I said that if we cross below 4.30, that's going to be bullish for now because it alleviates the uncertainty about whoever been dumping U.S. bonds, assumingly China, of course, that they're done right now. So that's supposed to be a bullish sign, but you gotta look at all indicators. And if you begin to see a recessionary reaction in the rest of the market, such as the HYG would probably be your best guide. If the HYG begins to head down, and then you see the 10-year heading below 4.3, beginning to lose momentum and begin to flush down again, and you see equities also going down along with this kind of dynamic, then it is giving you a confirmation of, yeah, we're back to recession fear now. And in recession fear, since the whale is done dumping bonds, we're going to go back to the safety of bonds. I think that's going to come at the expense of gold. So if you're taking notes, if you see the dynamic of HYG going down, bond yields, 10-year heading down, TLT, of course, will be heading higher, but equities heading down. I think it's going to be bad for gold because money's going to rotate out of gold to chase U.S. bonds. If you see that dynamic, another confirmation I want you to look at is crude oil. Is it trading up or trading down? If it's trading down, okay, then now crude is participating in the recession theme. If it is trading higher, then crude is suggesting that we have a stagflation theme. What about the big kahuna apple? We lost 196, so that's a bearish confirmation. Momentum is rolling over, as you can see here in the RSI. It's not over yet for Apple. It could pull a nice trick here for an ABC pattern. That's the bullish outlook, still not dead, but the case is now tilting toward the bear side by the loss of 196. You also got the Bollinger Bands now expanded, so you have plenty of room if you take a price measure here approximately. We can go down all the way to the lower Bollinger Bands. That's going to be about 10% loss. So we suggested some trades here on Apple. We have one trade for May 15th. I'm going to stick with that. But you can go with the 190, 180. That's going to be a viable trade for the monthly expiration of May. Of course, you're buying the 190, you're selling the 180, and I think it's going to be a decent trade, especially if you see it close again below 196 in tomorrow's session. Now, what about NVIDIA? NVIDIA was down big today, but we've seen buying at the end of the session. So in tomorrow's session, it's going to be all about 106.5. That's a really critical number. Now, right now, it's giving you a bearish confirmation, which means that if you want to trade NVIDIA, you probably want to go with the 190 put debit spread, and you go with the expiration date of May 16th, which is the monthly expiration. But if you want to wait for confirmation, if you're not sure, another close below 106.5 in tomorrow's session will be all of the confirmation that you need. Of course, you would prefer that we close the gap higher. Let's say we open higher for whatever reason it is, and then head down and lose 106 later, 106.5, I should say. If that is the case, then you got a confirmation that I don't have to worry about the gap, because if it just goes down all the way here, you could see a quick rebound as traders begin to bet that, hey, we left a gap open here. And usually we're not going to leave gaps open, as you can see here in NVIDIA's chart. Anything to see in the souffle here, Tesla? We have flirted with the loss of 236 where Mama Bear is, but we closed above. So no confirmation yet, and I think that the trade on Tesla should be at least delayed all the way till Monday, because it got the earnings report coming out Tuesday, I believe, Tuesday the 22nd. So I think you can wait. You don't have to place it right now, then you see a big move up or down, and now your strikes have to be adjusted. So why not wait till at least Monday or Tuesday before the close to open that trade against Tesla, or maybe for Tesla, if you think it's going to be a good report. Whatever your direction is, doesn't matter. But I think the timing is important, that you at least let the decay that's going to happen in the long weekend takes its course, and then you want to bet on the earnings play. So to recap, folks, looking at the indicators that we got, we have more bearish indicators obviously being triggered right now. If we get a close below 5,300 in tomorrow's session, that's going to be, for me, the ultimate one. But did anything change about these indicators based on today's activities? Yes. So now we're not really sure if the 10-year trades above or rather below 4.3. that's going to be a bullish sign, because if it goes down along with HYG, that's going to be your recession signal that no, 10-year going below 4.3 is not bullish. It's actually bearish. So if you guys taking notes, this is a really important one. The other one is for gold. So I said that if gold is below 3,200, that's supposed to be bullish because money will be freed from gold to chase the dip in the market. But context matter. In the context here, if we see gold below 3,200 or just pulling back for whatever reason, because it is overcrowded, overbought right now, but you see the TLT heading higher and the market heading down, be careful. That's not a bullish confirmation by gold. That's actually a bearish confirmation. So I'm going to sort all of this out for you. In case you didn't take notes, I'm going to sort all of this out for you in tomorrow's morning brief in Discord. Stay tuned for that one. And let's move on to the conclusion of this video. What do we have in the economic calendar tomorrow? Thursday the 17th, last day of the week. You can take a long holiday here. Initial jobless claims will be important to see the federal workers' impact on the jobless claims. Important data in the housing market from housing starts and building permits. And then we got the Philly Fed Manufacturing Survey. And we conclude by Fed Governor Zombie Barr. More interesting than the macro calendar is the earnings calendar. Right off the gate, we get UNH. Really important. And then we get AXP. To me, this is going to be the most important earnings of tomorrow's session. AXP, Amex is a pulse on the affluent consumer. And this is going to be really important before the open. After the bell, we have Netflix. That's going to be really important. I think that Netflix is going to show resiliency in a weakening economy because usually folks are not going to cancel their membership at Netflix unless things get really, really bad. Because even if you lose your job, you'll be staying at home. You got to watch some Netflix. So you're not going to cancel that. The only negative could be that maybe all of the good news are priced in Netflix. We might see weakness in international markets, Middle East, Africa, Europe, Asia, whatever it is. We might see some consumers over there at least cutting because it could be a bigger expense for them. So we'll be on the lookout here for Netflix. But folks, I think this was another interesting show. Thank you for joining us tonight, but this is all I got for you for now. A reminder, we'll be back on Discord in tomorrow's session, and we have a new Easter schedule, by the way, just for this week. 10 Pacific time is the live stream for the Top Guns, and the closing hour is the chat for all other Discord members. But this is all I got for you for tonight, folks. Thank you for listening. Thank you for watching. I appreciate and I love all of you. I'll be talking to you again tomorrow. Good night.
I'm concerned about a Chinaman who thinks it's wise to come to a business transaction with automatic weapons. For his own good, tell Bruce Lee and the Karate Kids none of us are carrying automatic weapons. Because here, in this country, it don't add inches to your dick. You get a life sentence for it.